You know how banks are always hitting us with fees for everything? Account fees, overdraft fees, ATM fees. It feels like a one-way street where we're always paying them. But what if I told you about a guy who flipped the script? He figured out a way to make the bank pay him a fee every single time he took out cash. It sounds like something out of a movie, but this really happened, and it's a masterclass in reading the fine print. This story begins with a bank, let's call them Big Bank, launching a shiny new credit card. To attract new customers and make a big splash in the market, they came up with what they thought was a brilliant promotion, a whopping 5% cashback on all transactions for the first month. No categories, no spending caps, just a straight-up 5% back on everything you buy. They plastered this offer everywhere: billboards, online ads, TV commercials. The message was clear: spend money with our card and we'll give you a big chunk of it back. It was an aggressive, almost desperate move to grab market share. Now, in the world of finance and credit cards, a 5% universal cashback rate is basically unheard of, especially without a cap. Most cards offer that kind of rate only on specific rotating categories like gas or groceries, and there's almost always a limit to how much you can earn. Big Bank was playing a high-stakes game, betting that the initial loss from the promotion would be offset by gaining loyal, long-term customers who would stick around and pay interest long after the first month. This is where our protagonist enters the picture. Let's call him Alex. Alex wasn't a criminal mastermind or a hacker. He was just a regular guy who was incredibly sharp and paid close attention to details. When he saw the ad for the new credit card, his interest was piqued. Like most of us, he was skeptical. An offer this good had to have a catch. So he did what very few people actually do. He decided to read the terms and conditions, the whole thing. All the dense, boring legal jargon that's designed to make your eyes glaze over. He spent hours poring over the fine print, line by line. He was looking for the loopholes, the exclusions, the gotchas. He found the usual stuff about late fees and interest rates. But then he noticed something that wasn't there. The promotion promised 5% cashback on ALL transactions. Typically, credit card companies are very careful to exclude certain types of transactions from these rewards programs. Things like balance transfers, buying gift cards, and most importantly, cash advances. A cash advance is when you use your credit card to withdraw cash from an ATM, just like you would with a debit card. Banks usually hate when you do this. They charge you a hefty upfront fee, often around 3 to 5% of the amount you withdraw, plus a higher interest rate that starts accruing immediately, with no grace period. It's one of the most expensive ways to borrow money. Because of this, cash advances are almost always excluded from cashback rewards. It just wouldn't make sense for a bank to give you a reward for taking out a high-interest loan. But in their haste to launch this massive promotion, Big Bank had made a colossal mistake. In their lengthy terms and conditions, they had forgotten to add the single crucial line that excluded cash advances from the 5% cashback offer. To Alex, this wasn't just an oversight. It was a golden key. A door had been left wide open, and he had just found it. A plan started to form in his mind. It was simple, elegant, and perfectly legal, all based on the bank's own rules. He applied for the card and was approved almost instantly. The shiny new piece of plastic arrived in his mail a few days later. For Alex, it wasn't just a credit card. It was a license to print money. The next day, Alex put his plan into action. He walked up to a random ATM, not one owned by Big Bank, but a third-party one. This was a deliberate choice. He inserted his brand new credit card and requested a cash advance. He didn't just take out $100 or $200. He went big. He withdrew the maximum amount the ATM would allow in a single transaction, $10,000. The ATM whirred, counted the bills, and spat out a fixed stack of cash. As this happened, The ATM network did its thing. It charged him a standard cash advance fee. Let's say it was a flat fee of $10 for using that particular machine. From the bank's perspective, everything looked normal. They saw a $10,000 cash advance. They charged him the $10 fee. They probably thought they had just made a quick $10 and had a customer who was now on the hook for a high-interest loan. They were probably rubbing their hands together, thinking this was business as usual. But they had completely missed the other side of the equation. Because of their own promotional rules, that $10,000 withdrawal wasn't just a loan. It was also a transaction. And according to the terms Alex had read so carefully, all transactions qualified for 5% cashback. So let's do the math on that very first transaction. Instantly, a $500 credit appeared in his credit card rewards account. So to recap, he had $10,000 in cash in his hands. He owed the bank $10,000 on his credit card. He was out $10 for the ATM fee, but he had gained $500 in cashback rewards. He could immediately use that reward to pay down his balance. So after paying the $10 fee, he was left with a net profit of $490 for about 5 minutes of work. This is where the genius of the loop comes in. What do you do when you've just made nearly $500 for free? You do it again. Alex took the $10,000 in cash he had just withdrawn and walked straight into a branch of his own regular debit card bank. He deposited the entire amount, all $10,000, right back into his checking account. Now his checking account was full again, ready for the next step. What was the next step? He went to his online banking portal and made a payment to his new credit card. How much did he pay? He paid off the entire $10,000 balance from the cash advance. Since he was paying it off immediately, often on the same day, he wouldn't accrue any of that high cash advance interest. The balance was cleared. His slate was clean. And what was the result of this full cycle? His bank account balance was exactly the same as when he started, minus the $10 ATM fee. His credit card balance was back to zero, but his rewards account had a new balance of $500. He had essentially created a money-making machine fueled by the bank's own mistake. But Alex was thorough, so he did it again. He would visit multiple ATMs, pulling out the maximum each time. He learned which ATMs had the highest limits and the lowest fees. He was running a full-fledged one-man arbitrage operation. Each loop took maybe 30 minutes. Go to the ATM, get the cash, go to his bank, deposit the cash, go online, pay the credit card bill. Repeat. 10 times a day, he was pocketing a profit of around $490. That's nearly $5,000 a day. Tax-free, because credit card rewards aren't considered income by the IRS. They're treated as a rebate on a purchase. Even if the purchase was just borrowing cash to put right back in the bank, he was literally getting paid by the bank to take their money for a short walk around the block. Alex was earning thousands of dollars a day, doing nothing more than moving money from one pocket to another. At big bank headquarters, someone in the analytics department must have started noticing some very strange patterns. They would have seen a single account making massive, repetitive cash advances, followed by immediate full payments day after day. At first, they might have flagged it for potential fraud or money laundering. And that's when the cold, dawning horror must have set in. They would have followed the trail. They'd see the cash advance. They'd see the immediate payment. And then they'd see the monster cashback rewards being paid out on every single transaction. They would have scrambled back to their marketing materials, to the terms and conditions of their own promotion. And there, or rather not there, they would have found their $1,000,000 mistake, the missing exclusion clause for cash advances. You can just imagine the panic in the office. Alex and probably a few other savvy people who had figured out the same loophole was costing them thousands of dollars. They were hemorrhaging money because of a single overlooked sentence in a legal document. The bank moved swiftly to stop the bleeding, as he was technically following their rules to the letter, announcing that the 5% cashback offer was ending immediately due to unforeseen circumstances or some other vague corporate speak. The golden window had slammed shut. By the time the dust settled, it's estimated that Alex had managed to pull this off for about 3 weeks. 10 loops a day, around $490 profit per loop for about 20 days. You can do the math. All because he took the time to read the fine print and understood the system better than the people who created it. It's a perfect example of what's called manufactured spending, but taken to an extreme level. It highlights the constant cat-and-mouse game between consumers looking for an edge and banks trying to protect their profits. And while this specific loophole was closed long ago, it serves as a powerful reminder. Sometimes the biggest opportunities are hidden in plain sight, buried in the boring details that everyone else ignores. Alex didn't break any laws. Thanks so much for watching. If you enjoyed this story, make sure to hit that like button and subscribe for more tales of financial genius and corporate blunders. See you in the next video.